Welcome to Independent Wealth Planner Strategies with Jennifer Lang, helping pre-retirees and retirees build, preserve, and protect their financial assets in today's volatile market.
Welcome to today's webinar. I'm Mike Payne, and your host for today is Jennifer Lang. Jennifer is an author, a speaker, and a licensed financial services professional who found her love for financial literacy the hard way. Her career goals were on track as she tackled the hustle and bustle of working in New York City as a corporate manager. That is, until life threw her a curveball that would change her direction. Her mother became ill, and Jennifer only had one choice. She left New York and became her mother's full-time caregiver. It was during this 10-year period that Jennifer learned firsthand the importance of how life insurance protects an individual and a family while they are alive, as well as how having long-term care benefits in place can empower family members and relieve burdens. She found a new passion and purpose to help the underserved middle class protect against the emotional, physical, and financial stresses of caring for their loved ones. Currently, she works with businesses and families in all 50 states to acquire business loans, life insurance, and annuities. She is contracted through One Resource Group, and you can contact her through her website, JenniferLangFinancialServices.com. So, without further ado, Jennifer, take it away.
Thanks, Mike. I'd like to welcome and thank everyone for attending today. My name's Jennifer Lang, and this webinar is being recorded and will be available for rebroadcast later on. So please submit all questions via our website, JenniferLangFinancialServices.com. The chat is open, so tell me your name and where you're from, and I'll get to questions as time allows. I see some names in the chat box already. Hi, Denise from Louisiana. Good to see you. Tasha from Ohio. Good to see you too. I see Christopher from Utah. Glad you made it. Awesome. Well, thank all of you for joining today. Today's webinar is entitled Investment Strategies for Retirement. And as Mike mentioned, a person can either learn things the easy way or they can learn things the hard way. And in my case, when my mom got sick, I learned the hard way. I, like most people, thought that life insurance was just something you had in order to pay for a funeral. I didn't know that it was such a powerful wealth accumulation and protection vehicle. So I do these webinars and I speak to businesses and organizations because I want to help as many people as I can reach their hopes and dreams and avoid that financial learning curve that I went through. So let's jump in. You've probably given a lot of thought to what your dream retirement will look like. Now it's time to decide how you're going to pay for it. Like the rest of life, retirement doesn't come with guarantees, but a sound investment strategy is an excellent start toward helping you pursue your retirement goals. At JenniferLangFinancialServices.com, we provide a wide range of services with the primary commitment of helping our clients pursue their unique financial objectives. We believe in helping you develop a financial strategy tailored to your goals, values, and most of all, risk tolerance. JenniferLangFinancialServices.com is dedicated to informing our clients regarding all areas of personal finance. In order to facilitate this process, we offer informational materials such as this webinar on a wide range of topics. If you have any questions or concerns during the course of this presentation, we invite you to take advantage of our complimentary consultation. Keep in mind that the information in this material is not intended as tax or legal advice, and it may not be used for the purpose of avoiding any federal tax penalties. Please consult a professional for specific information regarding your individual situation. When approaching your retirement years, certain questions take on paramount importance. First, barring unforeseen circumstances, how long should we expect retirement to last? Second, how can we potentially determine what this new phase of life may cost? Third, What sources of income do we anticipate having? Fourth, what investment strategies can help us pursue the goals we have for our retirement? Let's examine these questions one at a time. Over the last century, life expectancy has risen dramatically in the U.S. In 1900, the average life expectancy was 49.2 years. According to the most recent statistics available, Americans had a much higher life expectancy of 78.6 years in 2017. The current retirement age of 65 years was established in 1935, when average life expectancy was much lower. With all the advances in technology and medicine, it's possible that many of today's retirees may live much longer than their ancestors. 1 out of 3 males and 1 out of 2 females in their 50s today will live to age 90. For a 65-year-old couple, the life expectancy goes up even more. There is a 50% chance that one of them will live to age 92. Second question, how much is retirement expected to cost? You've probably seen projections that estimate anywhere from 60% to 90% of your current income may be needed as your retirement income. But this approach, while simple, may give you an unrealistic idea of what you potentially might need. Instead, look at your current expenses and decide which of those are expected to remain after you retire. It's important to be realistic about your basic needs. You might not think of listing things like pet care, yard maintenance, and regular visits to salons or spas. But if you enjoy those services now, you may want them during retirement. And you might find that you underestimated the real cost of maintaining your desired lifestyle. In addition, gifts to children and grandchildren, as well as financial help for those dependents, may represent an extra expenditure during retirement years. All of these basic needs should be accounted for in advance. Remember, even though you enter a new phase of life, you remain the same person. In addition, make a realistic assessment of your activities during retirement. What goals or hobbies do you intend to pursue, and how expensive do you anticipate they will be? Finally, many of us have special circumstances that may require additional resources during retirement, and these must be factored in. Once you have estimated the income you may need in retirement, you can then estimate the cost of the retirement you want. The next step is to account for other income sources, such as Social Security, IRAs, and any qualified retirement plans. To estimate how much each may potentially provide, take a look at your most recent statement. With these numbers in hand, estimating any shortfall you may have is a matter of subtraction. That is, from your estimate, subtract the income you anticipate from the income you may need in order to maintain the lifestyle you want. You may also want to account for economic factors that can impact your retirement portfolio's performance. Also, taxes, inflation, and investment risk may have a role to play. Keep in mind, the estimates and guidelines suggested are for informational purposes only and should not be considered a substitute for a more comprehensive review. Traditionally, retirement funding has been viewed as a three-legged stool, implying a balance between Social Security, retirement plans, and savings and investments. As the baby boomer generation ages, there is a potential that Social Security benefits may decrease, or the age at which an individual can collect benefits may also increase. Changes in employment may affect retirement plans. As a result, the third leg of the stool, savings and investments, may become even more important. Let's take a closer look at how the long-term trend of aging may influence Social Security. Social Security is facing a major challenge. The number of people who are expected to depend on benefits is increasing as the number of people paying into the system is decreasing. As the chart shows, the over 65 population has been increasing steadily for the past 100 years, and that upward curve is expected to get a bit steeper now that the baby boomers are entering retirement. In 2018, the Social Security Administration reported paying out more than it took in for the first time in decades. If no changes are made, the trust fund is expected to be completely exhausted by 2034. For years, Congress has considered proposals to make changes to Social Security. No one's certain what Congress may do, but one option could be to raise the age at which retirees become eligible for benefits. Another might be to reduce benefits. Whatever the case, Social Security may not be able to provide enough funding to be an individual sole source of retirement income. The following video goes over 5 things you may not know about Social Security.
What you don't know about Social Security could cost you a lot. That's because there are important decisions ahead of you about how and when you take your Social Security benefits. And what you choose can play a big part in the amount of income you'll receive during your retirement years. You need to understand the many choices ahead of you. For example, here are 5 things you may not know about Social Security. Example number 1. Taking your Social Security benefits before your full retirement age will decrease the payment amount you receive, but delaying your benefits may increase the payment amount. Number 2. If when you retire, you still have a child under age 18 or a disabled child of any age, you may be eligible for special benefits. Number 3. If you're divorced, you may be eligible for certain benefits based on the earnings history of your ex-spouse. Number 4. Your Medicare premium will be deducted from your Social Security income. Finally, example number 5, and this is really important. Your Social Security benefits alone may not be enough to assure you of the retirement you want. That's why you should think of your Social Security benefits as just one part of your total retirement income strategy, and why you may want to learn about Social Security benefit options, which may help increase the amount of your Social Security benefits. After all, if you have more retirement income, you can have more retirement options. Talk to your financial professional and your tax advisor about how Social Security benefits can fit into a complete retirement income strategy. Financial professionals are able to provide you with information, but not guidance or advice related to Social Security benefits. For more Social Security information, go to www.ssa.gov.
The second leg of that 3-legged stool is retirement plans. As the chart illustrates, 53% of workers today expect their employer-sponsored retirement plan to be a major source of income in retirement, but only 24% of retirees say that it is. On the other hand, only about 1/3 of workers say Social Security will be a major source of income when they retire, but 2/3 of current retirees report that Social Security plays a major role in providing income for them. In today's economic climate, the thought that 66% of the population relies heavily on Social Security is an increasingly scary thought, and one that we need to address with some long-term planning options. If the objective is to safeguard principal, a certificate of deposit is one option. CDs are insured by the Federal Deposit Insurance Corp up to $250,000. Holding money in a money market fund is another approach. Money market funds are investment funds that seek to preserve the value of your investment at $1 a share. However, it is possible to lose money by investing in a money market fund. Individual bonds, income-oriented mutual funds, and fixed annuities can be structured to generate a steady stream of income. Bonds have different maturities and are subject to interest rate, credit, and inflation risk. When interest rates increase, bond prices generally will fall, which may affect a bond or a bond fund's performance. Bonds redeemed before maturity may be worth more or less than their original cost. Market conditions will affect the return and principal value of bonds and bond funds. Income-oriented mutual funds may be appropriate for certain types of investors. The guarantees of an annuity contract depend on the issuing company's claims-paying ability. Annuities have fees and charges associated with the contract, and a surrender charge also may apply if the contract owner elects to give up the annuity before certain time period conditions are satisfied. The earnings component of an annuity withdrawal is taxed as ordinary income, and if taken before age 59 and a half, may be subject to a 10% federal income tax penalty. A surrender charge may apply if the contract owner gives up the annuity before time period conditions are satisfied. For growth potential, individual stocks, growth-oriented mutual funds, and variable annuities may be appropriate. Stocks will fluctuate in value, and when sold, they may be worth more or less than the initial price. Mutual funds and annuities are sold only by prospectus. You should consider the charges, risks, expenses, and investment objectives carefully before investing or entering a contract. A prospectus containing this and other information about the investment company or insurance company can be obtained from your financial professional. Read it carefully before you invest or send money. The following video discusses how an annuity can help you live the life you plan.
Question: how can I take some pressure off my retirement portfolio? Allianz answers. Does the prospect of saving for retirement seem more daunting than ever? You may be concerned with market losses, the risk of outliving your money, and inflation. If you're trying to preserve your portfolio in an era of low rates and increased volatility, there's also the question of how you'll generate predictable, sustainable, and potentially increasing income, and that's only half of it. Compared to previous generations of retirees, your retirement strategy will need to rely more heavily on your personal assets to achieve your objectives. It all adds up to a lot of pressure on your portfolio. You may be thinking,
sure, there are risks, but how significant are they?
Consider this. Too much pressure on your portfolio can lead to depleting it and running out of money sooner than you expected. So much for living comfortably in retirement. The difference between a more secure future and a more uncertain one could be the success of your retirement income strategy. Our hypothetical friends, Owen and Clara, are here to show us why. They're the same age, they're each starting with $750,000 in savings, and both of them want to generate $40,000 in annual income in retirement in 5 years with no more than a 4% withdrawal rate.
While Owen is approaching retirement with his retirement account only, Clara plans to combine her retirement account with a fixed index annuity, or FIA. Let's start with Owen. To reach his goal, he needs to grow his $750,000 savings to $1 million in 5 years. During those 5 years, Owen will continue to grow his retirement account without making additional contributions and without making withdrawals. That will require his savings to produce an average annual return of 5.92% net fees. What are the benefits of Owen's strategy? For starters, he has control, liquidity, and flexibility of his assets, and the potential opportunity for more gains compared to other strategies. Except his assets are unprotected and exposed to risks, like market risk, sequence of returns risk, and the possibility of outliving his money. That means his income isn't guaranteed to last his lifetime either. And as another disadvantage, his account needs to return 5.92% net fees every year. So much for taking some pressure off his retirement portfolio. Let's check in to see how Clara is doing with her combined approach, a retirement account with an FIA.
In case you aren't familiar, an FIA is designed to meet long-term needs for retirement income. Some of the benefits include protection from market losses, tax deferral to help Clara grow her savings faster, the potential for credited interest based on positive changes in an external index, a death benefit to help her leave a legacy, and guaranteed income for life. Now, compared to an approach that uses her retirement account only, an FIA may offer Clara less control, liquidity, and flexibility of her assets for a period of time. This is because FIAs have a surrender charge and a market value adjustment if they are surrendered too early. Also, FIAs may have less growth potential than a sole retirement account has. Certain factors like caps, spreads, and participation rates will limit the amount of indexed interest credited. Clara's needs may change as time goes on, which is why it's important to understand the balance between all available features with any annuity. So, Clara purchases an FIA with $225,000 and continues to invest her remaining $525,000 in her retirement account, which is invested the same as Owen's retirement account and requires the same 4% withdrawal rate. After 5 years of waiting, her fixed index annuity would generate this much guaranteed lifetime income. As a result, she successfully reduces the pressure on her retirement account to generate the balance of income and only requires an average annual return of 2.34% net fees to achieve the same $40,000 in income as Owen. Keep in mind, this assumes no interest is credited to Clara's annuity during the 5-year period. In fact, any FIA interest she earns would take even more pressure off her portfolio, reducing her required average annual return of 2.34%. Clara's combined approach is more efficient than Owen's only retirement account because it requires a lower rate of return to generate the same amount of income and reduces the overall risk of outliving her money as well as withdrawal pressure. Her approach also adds more flexibility and potential for income and growth because a portion of Clara's expenses are covered with guaranteed lifetime income. These factors will help take some pressure off her retirement portfolio in exchange for a level of certainty toward the lifestyle she hopes to sustain.
No one, not even Owen or Clara, can predict how long they'll live or how the market will affect their retirement. That's why it may be important to manage and protect a portion of your portfolio from longevity and market risk with a fixed index annuity to help you maintain the retirement lifestyle you want for as long as you live. Ask your financial professional how a fixed index annuity could help take some pressure off of your retirement portfolio.
Many investors place a portion of their portfolio in a position designed to protect principal. This is a secure portion that is exposed to little market risk. Among the more common investments in this class are money market funds, certificates of deposit, and U.S. Treasury bills, which are backed by the full faith and credit of the U.S. government as the timely payment of principal and interest. If a Treasury bill is sold prior to maturity, there is the opportunity for a capital loss or capital gain, depending on the interest rate environment. Keeping too much of a portfolio in secure investment exposes a person to another risk, inflation. Low-risk investments tend to generate low rates of return, and over some periods, low-risk, low-return investments may fail to keep pace with inflation. Interestingly enough, many investors have historically moved in and out of these investments depending on the volatility of the market. The blue line on this chart shows the performance of the Standard & Poor's 500 stock index. That's the S&P 500, okay? So generally regarded as a representative of the U.S. stock market. Beginning in October 2008, the S&P 500 experienced a steep drop that lasted through March 2009. Then, stock prices began to recover. The green line shows the total dollars invested in money market mutual funds. As the chart shows, money kept in money market funds began to rise in a near mirror image of the S&P 500. As the stock market fell, investors moved from cash into money market funds. Then, when the market began to recover, money market fund assets trended lower. The S&P 500 Composite Index, that's the total return, is an unmanaged index that is generally considered representative of the U.S. stock market. Index performance is not indicative of the past performance of a particular investment. Past performance does not guarantee future results. Individuals cannot invest directly in an index. Actual results will vary. The second investment objective for many retirees is to generate income. Among the more common income-generating investments are individual bonds, income-oriented mutual funds, and fixed annuities. When considering investments that generate income, it's important to remember that bond prices rise and fall daily. If a bond is held to maturity, a bondholder will receive the interest payments due plus original principal, barring default by the issuer. A bond fund's net asset value, the NAV, will fluctuate with the price of the underlying bonds in the portfolio. The NAV also may fluctuate as a result of turnover activity. Bond fund shares may lose principal during a period of rising interest rates. Return of principal is not guaranteed. Generally, annuities have surrender fees that are usually highest if you take out the money in the initial years of the annuity contract. However, most annuity contracts do offer a free withdrawal provision. A free withdrawal provision is the amount that an annuity contract owner may withdraw each year without incurring any early withdrawal fees. This amount varies, but typically is 10% per year until the surrender charge period has expired. Withdrawals and income payments are taxed as ordinary income. If a withdrawal is made prior to age 59 and a half, a 10% federal income tax penalty may apply, unless an exception applies, right? So that's just like your 401k withdrawals. Got it? Okay. So the guarantees of an annuity contract depend on the issuing company's claims paying ability. Now, with an annuity contract, you are locking in your gains so that there is no loss of principal due to market volatility. So you would want to look for a company who has an A+, or an A- rating. Those would be the very best. Annuities are not guaranteed by the FDIC or any other government agency. They are, however, guaranteed contracts issued by life insurance companies. Investing in mutual funds is subject to risk and potential loss of principal. There is no assurance or certainty that any investment or strategy will be successful in meeting its objectives. Investors should consider the investment objectives, risks, charges, and expenses of the fund carefully before investing. The mutual fund's prospectus contains the fees and other information about the fund. Contact the fund company directly or your financial professional to obtain a prospectus, which should be read carefully before investing or sending money. There are a number of approaches that can be used when attempting to generate income. For example, bond laddering is a strategy that can be used by individuals who prefer to own individual bonds. Bond laddering seeks to manage exposure to interest rate fluctuations. Here's how it works. An investor purchases 3 $10,000 bonds, one of which matures in 1 year, one in 2 years, and one in 3 years. They pay a hypothetical 1%, 1.5%, and 2% respectively. Okay? At the end of the first year, when the 1-year bond comes due, our investor uses the proceeds of that bond to invest in a hypothetical 2% bond with a 3-year maturity. At the end of the second, the investor uses the proceeds of the 2-year bond to invest in another hypothetical 2% bond with a maturity of 3 years. Since our investor is reinvesting the proceeds from 1/3 of these bonds each year, the investor is attempting to manage interest rate fluctuations. If interest rates rise, our investor strategy is designed to potentially take advantage of the increase. Similarly, if interest rates decline, our investor has established positions that take advantage of earlier rates. It's important to remember that the market value of a bond is at risk when interest rates fluctuate. But investors that hold bonds to maturity will receive interest payments due plus the original principal, barring default by the issuer. Investments seeking to generate higher yields also involve a higher degree of risk. Also, none of the fees and expenses associated with investing are included in this example. Diversification is an approach to help manage investment risk. It does not eliminate the risk of loss if security prices decline. Here's a closer look at the bond laddering strategy. In year 1, the portfolio had a hypothetical yield of 1.5%. In this hypothetical example, interest rates are rising slightly, which allows the investor to purchase bonds with slightly higher market rates. In year 2, the portfolio had a hypothetical yield of 1.83%, and in year 3, 2%. This bond laddering portfolio has been simplified to illustrate the concept. An actual bond laddering strategy may be more complex and involve additional fees and expenses. This is a hypothetical example used for illustrative purposes only. It is not representative of any specific investment or combination of investments. Now, similar to bond laddering is annuity laddering. The following video gives us an overview of a hypothetical example for annuity laddering.
When we are ready to retire, we must convert the growth of our savings and investments into a source of regular and reliable income, an income that will last for 20 or 30 years of retirement. Of course, most financial advisors will advise us to withdraw only the interest, dividends, or profit on our investments so that we can never run out of money. But we know that interest rates, stock dividends, and market valuations will vary considerably from year to year, especially over 20 or 30 years of retirement. And if our investment earnings cannot provide us with enough income, we will need to take withdrawals of both earnings and principal, and manage those withdrawals very carefully as we spend down our savings over 20 or 30 years. But if we make any miscalculations, or if our investments do not perform as well as we expect them to, or if we should live longer than 20 or 30 years, we could very easily run out of money. So what's the alternative? Well, we can convert our retirement savings into 3 separate 10-year payout periods, each one with a certain guaranteed income, and the third one with a guarantee to continue the payout for as long as we live, even if we live into our hundreds. These payout periods are referred to as income buckets, and they can replace the uncertainty of interest rates, stock dividends, bond yields, and market valuations with the certainty of a regular and reliable guaranteed monthly income. It's like having our own personal pension plan. What's more, income buckets enable us to safely and confidently take as much as 30% more income during the first 20 years of our retirement, because we know with certainty and assurance that we will have sufficient income guaranteed during the second 20 years of our retirement, or for as long as we live. What's more, we can do it all without any risk of taking out too much or too little, and without any dependence on interest rates, bond yields, stock dividends, or market valuations. So we never need to worry about the safety of our money, or the need to carefully manage our investments. Here's an example of how it works. The first income bucket might begin at age 60 or 65 and pay out all of that money over the first 10 years of our retirement before it would be replaced by the second income bucket. So the second income bucket would begin at age 70 or 75 and pay out a new monthly income guaranteed for another 10 years to age 80 or 85. And this second 10-year payout can be higher than the first 10-year payout in order to offset the rate of inflation. Now, the third income bucket would only begin the payout if we make it to age 80 or 85. And this third bucket would be guaranteed not just for another 10 years, but for as long as we live, even if we live to be 120. And if we don't make it to age 80 or 85, our heirs will receive annual installments until all the money we put into that bucket is paid back out. Would you like to know how much more money you can get with an income bucket plan? Talk with the financial security professional or the retirement planning specialist who asked you to watch this video.
Now, while bond laddering is appropriate for some investors and annuity laddering is appropriate for savers, others prefer stock market strategies. These investors prefer to leave their portfolio strategies to the professionals. They rely on mutual funds that are designed to generate income. Income-oriented mutual funds focus on generating current income, either on a monthly or quarterly basis. Generating current income is the emphasis, rather than capital appreciation. Income-oriented mutual funds may be appropriate for certain types of investors. For example, income-oriented investors who are seeking a way to participate in the stock market may be attracted to income-oriented funds. Also, growth-oriented investors who want a fund that has the potential to manage market declines and long-term investors looking for a core holding may appreciate what income-oriented funds have to offer. Some income-oriented funds can invest in a wide range of investment options. Others are more limited in the securities they can choose from. A review of your personal situation may help determine whether an income-oriented fund is appropriate. Investing in mutual funds is subject to risk and potential loss of principal. There is no assurance or certainty that any investment or strategy will be successful in meeting its objectives. Investors should consider the investment objectives, risks, charges, and expenses of the fund carefully before investing. The prospectus contains this and other information about the funds. Contact the fund company directly or your financial professional to obtain a prospectus, which should be read carefully before investing or sending money. We touched on annuities earlier, but now I'd like to look at them as another income generation tool. Fixed annuities are interest-based vehicles that are similar to bank-issued CDs, but geared specifically towards retirement savings. In this example, the fixed annuity has an accumulation phase, where the annuity contract grows tax-deferred. Next, the fixed annuity enters a payout phase where the contract holder collects income. Fixed annuities are considered low risk and potentially can offer slightly higher returns than cash vehicles. Fixed annuities offer protection against market risk, and fixed annuities can be structured to offer a guaranteed source of regular income for a fixed term or for a person's lifetime. You also may want to consider investing a portion of your retirement portfolio for growth. Among the more common investments in this class are individual stocks, growth-oriented mutual funds, and variable annuities. When considering growth investments, it's important to understand what determines a portfolio's overall return. A landmark study found that 91.5% of a portfolio's return is a result of its overall asset allocation. That far outweighs any other factors, including selection of specific investments. That means it's far more important to develop a sound investment strategy than to pick individual stocks. It's far more important to invest in a mix of asset classes that are consistent with your strategy. However, past performance does not guarantee future results. An asset allocation is an approach to help manage investment risk. It does not eliminate the risk of loss if security prices decline. In this hypothetical example, an aggressive portfolio allocated 80% of its assets to stocks, with another 10% in cash and 10% in bonds. The hypothetical conservative portfolio had only 60% in cash, with the remainder divided between stocks and bonds, so 20% each. Over the past 20 years, the aggressive portfolio was volatile. In its best year, it returned 24.3%. In its worst, it lost 29.3%. Overall, it averaged a 6.2% annual rate of return for the period. Now, in its best year, the conservative portfolio returned 8.1%, and in its worst, it lost 7.1%. And over 20 years, it averaged a 3.7% annual rate of return. So, what's better? Well, that depends on your individual situation. However, the difference between a 6.2% return and a 3.7% return can add up over time. Stocks are represented by the S&P 500 Composite Index, the total return. an unmanaged index that is generally considered representative of the U.S. stock market. And in this, bonds are represented by the Citibank Corporate Bond Composite Index, an unmanaged index that is generally considered representative of the U.S. bond market. Cash is represented by the Citigroup 3-month Treasury Bill Index, an unmanaged index that is generally considered representative of the U.S. cash market. Index performance is not indicative of the past performance of a particular investment, and past performance does not guarantee future results. Individuals cannot invest directly in an index. Always got to get those disclaimers in there. Sorry. The difference between the conservative portfolio and the aggressive portfolio was roughly 2.5%. In this example, a $100,000 portfolio generated a hypothetical 6.2%, while another generated a 3.7% return over 20 years. At the end of the period, the portfolio that produced the hypothetical 6.2% annual rate of return was worth $281,729. The portfolio that produced the hypothetical 3.7% annual rate of return was worth $202,915. That's an $80,000 difference. Now, past performance does not guarantee future results, and actual results will vary. Developing an investment plan is a vital step in pursuit of your retirement goals. Here are some scenarios that might be familiar to you. Anthony and Selena have a variety of investments with a few different brokerage firms. They want to know, are our investments balanced in a way that is appropriate for our life stage and goals? What is an overall return on our investments, and how do we know if we need to make some changes? Rebecca is a single business owner nearing retirement. She wonders, will my retirement plan provide enough income along with Social Security and savings to meet my needs? How shall I pass my business along when I retire? Dave and Christina have grown children whom they help financially, and they care for a parent. They want to know, how should we best allocate our assets to provide enough income for our various dependents? Are there investment options that may help us defer taxes until we reach a lower income bracket? Isaac likes to invest in individual stocks and bonds after researching them online and watching reports on television. He asks, how are my individual stock and bond investments measuring up in comparison with the managed funds? Will the return on my investment portfolio outpace inflation? The answer to these and other questions will vary with each individual situation and can all be addressed in a review. So, to recap, there are a number of strategies you can use to attempt to accumulate the resources necessary to fund your retirement. And that's where we come in. At JenniferLangFinancialServices.com, we specialize in helping people just like you set up retirement strategies that help them pursue their retirement objectives. If you are ready to take a fresh look at your retirement investment portfolio, take advantage of our complimentary consultation and schedule a review today. Thank everyone for attending. Until next time! Fewer and fewer employers are offering pensions these days. If you own a business, chances are you're caught between a rock and a hard place. You want to keep operating costs low, but you also want to help your employees. At JenniferLangFinancialServices.com, we've got you covered. With life insurance-backed options that can provide more benefits than a traditional 401k, we will work with you to find the best plan to fit your retirement needs. Visit us online at JenniferLangFinancialServices.com. Protect your retirement from potential market downturns and risk. We offer annuities, 401k rollovers, and no market risk retirement planning. Visit us today, JenniferLangFinancialServices.com.